Disclaimer. I am not a SEBI-registered analyst. This article is for educational purposes only. Please consult a certified financial advisor before making decisions. Hey, so picture this. Your favorite jewelry brand, Kalyan Jewellers, just dropped its quarterly results. Profits up a whopping 49%, revenues up 31%. On paper, it almost feels like Diwali for investors, right? But then, the stock tanks. Nearly 9% down on the same day. How does that even make sense? Let's break it down together, so you're not just staring at red on your screen, but actually reading between the lines like a pro investor. Here are 7 key takeaways. Think of them as your cheat codes for decoding this puzzle. First, the numbers look great. Rs 264 crore profit, Rs 7, 268 crore revenue. But markets are forward-looking. They're not just pricing in what happened, but what might happen next. Sometimes it's not about how much you earn, but how you earn it. And this time, investors were more interested in the quality of the profits, not just their size. It's a good reminder. Are we sometimes chasing big numbers and ignoring how sustainable that growth actually is? Second, let's talk margins. Domestic gross margins fell from 14.2% to 13.6%. Why? More sales from franchise stores. Franchises help you grow fast, but you keep less profit from each sale. So yeah, revenue's up, but are we really making more per rupee? That's what's making some folks nervous. Third, Kalyan's digital arm, Kandery, saw revenue grow to Rs 66 crore. Not bad. But it's still making a loss of Rs 10 crore. Online jewelry is a hot trend, but Kandery isn't a cash cow yet. The big question, do you reward a stock for future potential, or do you wait for it to actually deliver profits? Fourth, expansion. Kalyan plans to open 170+ new showrooms this year. Massive, right? But here's the catch. More stores mean more inventory, bigger expenses, and stretched cash flows now, with profits possibly coming much later. It's the classic trade-off: growth today versus cash in hand. Are you okay holding a stock that might look choppy in the short run, just for a shot at long-term gains? Fifth, let's not forget market sentiment. On results day, the whole market was in a bad mood. Sensex fell 765 points, Nifty was down, jewelry stocks took a beating everywhere. Sometimes it's not about the company at all, it's just the broader market vibe. So always ask, is the fall about this company or just everyone heading for the exit at once? Sixth, not everyone's bearish. Brokerages like Citi and Motilal Oswal are still bullish, calling for a 30% upside, saying margin pressures are temporary and the expansion makes sense. Do you trust the experts, or do you want to see the proof first before jumping in? Seventh, seasonality and risk. Q1's numbers got a boost from festivals and weddings, but Q2 and Q3 might not be as shiny. Plus, gold price swings and heavy promotions could mess with profits. So, will the good times keep rolling, or are we in for a pause? Here's my takeaway. Kalyan Jewellers isn't in trouble. It's growing, it's ambitious, and analysts are optimistic. But margins are a worry. Kandery's still burning cash, and big expansion means big risks. If you believe management can juggle all this and deliver, maybe the dip is your opportunity. If you like your stocks simple, cash-rich, and predictable, maybe hold off for now. Bottom line, don't just chase growth. Look for growth that's profitable and sustainable. The market's telling us it's not just what you earn, it's how you earn it and how long you can keep it up. Stay curious, stay sharp, and always do your homework before investing.